United States Treasury Security. United States Treasury securities are government debt instruments issued by the United States Department of the Treasury to finance government spending as an alternative to taxation. Treasury securities are often referred to simply as treasuries. Since 2012, U.S. government debt has been managed by the Bureau of the Fiscal Service, succeeding the Bureau of the Public Debt. There are four types of marketable treasury: securities, treasury bills, treasury notes, treasury bonds, and treasury inflation-protected securities TIPS. The government sells these securities in auctions conducted by the Federal Reserve Bank of New York, after which they can be traded in secondary markets. Non-marketable securities include savings bonds, issued to the public and transferable only as gifts, the State and Local Government Series SLGS, purchasable only with the proceeds of state and municipal bond sales, and the Government Account Series, purchased by units of the federal government. Treasury securities are backed by the full faith and credit of the United States, meaning that the government promises to raise money by any legally available means to repay them. Although the United States is a sovereign power and may default without recourse, its strong record of repayment has given Treasury securities a reputation as one of the world's lowest risk investments. History. To finance the costs of World War I, the U.S. government increased income taxes, see the War Revenue Act of 1917, and issued government debt, called war bonds. Traditionally, the government borrowed from other countries, but there were no other countries from which to borrow in 1917. The Treasury raised funding throughout the war by selling $21.05 billion in Liberty bonds. These bonds were sold at subscription, where officials created coupon price and then sold it at par value. At this price, subscriptions could be filled in as little as one day, but usually remained open for several weeks depending on demand for the bond. After the war, the Liberty bonds were reaching maturity, but the Treasury was unable to pay each down fully with only limited budget surpluses. To solve this problem, the Treasury refinanced the debt with variable short and medium-term maturities. Again, the Treasury issued debt through fixed-price subscription, where both the coupon and the price of the debt were dictated by the Treasury. The problems with debt issuance became apparent in the late 1920s. The system suffered from chronic oversubscription, where interest rates were so attractive that there were more purchasers of debt than required by the government. This indicated that the government was paying too much for debt. As government debt was undervalued, debt purchasers could buy from the government and immediately sell to another market participant at a higher price. In 1929, the U.S. Treasury shifted from the fixed-price subscription system to a system of auctioning, where Treasury bills would be sold to the highest bidder. Securities were then issued on a pro rata system, where securities would be allocated to the highest bidder until their demand was full. If more treasuries were supplied by the government, they would then be allocated to the next highest bidder. This system allowed the market, rather than the government, to set the price. On December 10, 1929, the Treasury issued its first auction. The result was the issuing of $224 million three-month bills. The highest bid was at 99.310, with the lowest bid accepted at 99.152. Marketable securities. The types and procedures for marketable security issues are described in the Treasury's Uniform Offering Circular 31 CFR 356. Treasury bill. Treasury note. This is the modern usage of Treasury note in the U.S. For the earlier meanings, see Treasury note disambiguation. Treasury notes T-notes have maturities of 2, 3, 5, 7, or 10 years, have a coupon payment every 6 months, and are sold in increments of $100. T-note prices are quoted on the secondary market as a percentage of the par value in 30 seconds of a dollar. Ordinary Treasury notes pay a fixed interest rate that is set at auction. Another type of note, known as the floating rate note, pays interest at a rate that adjusts quarterly based on bill rates. A Treasury note is completely unrelated to a Treasury bill. The 10-year Treasury note has become the security most frequently quoted when discussing the performance of the U.S. government bond market and is used to convey the market's take on longer-term macroeconomic expectations. Treasury bond. Treasury bonds, T-bonds, also called a long bond, have the longest maturity at 30 years. They have a coupon payment every 6 months like T-notes. The U.S. federal government suspended issuing 30-year Treasury bonds for 4 years from February 18, 2002 to February 9, 2006. As the U.S. government used budget surpluses to pay down federal debt in the late 1990s, the 10-year Treasury note began to replace the 30-year Treasury bond as the general, most followed metric of the U.S. bond market. However, because of demand from pension funds and large, long-term institutional investors, along with a need to diversify the Treasury's liabilities, and also because the flatter yield curve meant that the opportunity cost of selling long-dated debt had dropped, the 30-year Treasury bond was reintroduced in February. In 2019, Treasury Secretary Steven Mnuchin said that the Trump administration was considering issuance of 50-year and even 100-year Treasury bonds. TIPS. Treasury inflation-protected securities TIPS are inflation-indexed bonds issued by the U.S. Treasury. The principal is adjusted with respect to the Consumer Price Index (CPI), the most commonly used measure of inflation. When the CPI rises, the principal is adjusted upward. If the index falls, the principal is adjusted downwards. The coupon rate is constant, but generates a different amount of interest when multiplied by the inflation-adjusted principal, thus protecting the holder against the inflation rate as measured by the CPI. TIPS were introduced in 1997. TIPS are currently offered in 5-year, 10-year, and 30-year maturities. Coupon stripping. The secondary market for securities included T-notes, T-bonds, and TIPS whose interest and principal portions of the security have been separated or stripped in order to sell them separately. The practice derives from the days before computerization, when Treasury securities were issued as paper-bearer bonds. Traders would literally separate the interest coupons from paper securities for separate resale, while the principal would be resold as a zero-coupon bond. The modern versions are known as separate trading of registered interest and principal securities strips. The Treasury does not directly issue strips; they are products of investment banks or brokerage firms, but it does register strips in its book entry system. Strips must be purchased through a broker and cannot be purchased from Treasury Direct. Non-marketable securities. U.S. savings bonds. 0% certificate of indebtedness. The certificate of indebtedness (COI) is issued only through the Treasury Direct system. It is an automatically renewed security with one-day maturity that can be purchased in any amount up to $1,000 and does not earn interest. An investor can use certificates of indebtedness to save funds in a Treasury Direct account for the purchase of an interest-bearing security. Government Account Series. The Government Account Series is the principal form of intragovernmental debt holdings. The government issues GAS securities to federal departments and federally established entities like the Federal Deposit Insurance Corporation that have excess cash. State and Local Government Series. The State and Local Government Series (SLGS) is issued to government entities below the federal level which have excess cash that was obtained through the sale of tax-exempt bonds. The federal tax code generally forbids investment of this cash in securities that offer a higher yield than the original bond, but SLGS securities are exempt from this restriction. The Treasury issues SLGS securities at its discretion and has suspended sales on several occasions to adhere to the federal debt ceiling. Holdings. Domestic. In June 2020, approximately $19.04 trillion of outstanding Treasury securities, representing 73% of the public debt, belonged to domestic holders. Of this amount, $5.09 trillion, or 22% of the debt, was held by agencies of the federal government itself. These intragovernmental holdings function as time deposits of the agency's excess and reserve funds to the Treasury. The Federal Reserve Bank of New York was also a significant holder as the market agent of the Federal Reserve System, with $4.06 trillion, or roughly 17%. Other domestic holders included mutual funds $3.06 trillion, banks $1.02 trillion, state and local governments $830 billion, private pension funds $740 billion, insurers $240 billion, and assorted private entities and individuals $2.03. International. As of June 30, 2025, foreign holders of U.S. Treasury